Another day, another story. The stock market and economic growth, unraveling the connection. Welcome back, fellow finance enthusiasts. Today, we are embarking on an exciting journey to explore the intriguing relationship between the stock market and economic growth. Get ready to witness the magic unfold in a way that even your grandma would understand. Let's dive right in. Picture this, the stock market is like a bustling marketplace where investors buy and sell shares of companies. It's a platform where businesses raise funds for growth, and investors get to be a part of that growth. Simple, right? Now, let's unravel how the stock market impacts economic growth. Imagine the stock market as a vibrant heartbeat of the economy. When the market is booming, it sets off a chain reaction that supercharges economic growth. Here's how. 1. The wealth effect. When stock prices rise, investors feel richer and more confident. This surge in confidence prompts them to spend more on goods and services, giving a boost to the economy. 2. Capital formation. The stock market allows companies to raise funds for expansion and investment. More investment means more jobs, increased productivity, and ultimately, economic growth. 3. Sparking confidence. A thriving stock market sends a powerful signal that the economy is doing well. This confidence inspires businesses and entrepreneurs to take risks, invest in new ventures, and ignite economic growth. Hold on, it's not a one-way street. The stock market is also influenced by the economy. Let's demystify some of these factors. 1. Macro matters. Big economic indicators like GDP growth, inflation, interest rates, and employment rates impact the stock market. Positive numbers create a wave of investor optimism, propelling the market upwards. 2. Industry insights. The stock market is like a compass, constantly reacting to the performance of different industries. Technological breakthroughs, for instance, can send the tech sector soaring, affecting the overall market. 3. Sentiment shakeup. Investors are humans, and their emotions can sway the stock market. Geopolitical events, market expectations, and even a tweet from a famous personality can create ripples of sentiment that impact stock prices and market volatility. Now, let's face the hurdles and risks that come with the stock market's impact on economic growth. 1. Rollercoaster rides. While a rising stock market fuels economic growth, sharp declines can have the opposite effect. Plummeting stock prices can make consumers hesitant, businesses cautious, and even trigger economic recessions. 2. Riches and divides. Remember, not everyone owns stocks. When stock ownership is concentrated in the hands of a few, wealth inequality can worsen, creating social and economic imbalances. 3. Bubble trouble. The stock market can be a wild playground for speculators. If unchecked, their risky behavior can inflate asset bubbles, leading to market crashes with devastating consequences for the economy. There you have it, folks. The stock market is a powerful force that intertwines with economic growth in captivating ways. It can generate wealth, drive innovation, and fuel optimism, but we must be mindful of the risks it poses. Understanding this dynamic relationship is crucial for investors, policymakers, and anyone curious about the fascinating world of finance and economics. Thank you for joining us on this enlightening exploration of how the stock market impacts economic growth. If you enjoyed this video, don't forget to like, subscribe, and share your thoughts in the comments below. Until next time, may your investments thrive, and your curiosity never fade. Thanks for watching.